Hello, my name is Ryan Littlestone from ForexFlow.live. Today we're going to talk about a welcome return to volatility in FX markets, in all markets in general. So what have we got at the moment? What landscape are we in? Well, what we've seen is that the market's getting very expectant about Fed rate cuts, and that's sweeping across pretty much all areas of the markets, from bonds to stocks to Forex. The reason for this is really a mix of the trade tensions going on between China and some slight softening in global data. We're seeing it more effective in the rest of the world than we are in the US, but the market's getting very touchy about whether that's going to infect the US even further, and we're going to see falls in economic activity there. I think personally that this is all really overblown. The market's really gone too far into this. I mean, we're seeing, the odds for a rate cut in July at the FOMC up in the 70% mark. It was down around 50% a week before. It's been as low as 18% if you go back some months. So we've really seen a big ramp up in these expectations, and we've seen bond yields fall. US 10 years are down near the 2% mark. A big psychological level, if not so much a technical level. And this has affected the dollar. We've seen dollar yen drop down. We've seen euro dollar, cable, they're all up on these expectations for Fed cuts. We've had some Fed members even coming out and not explicitly saying cuts, but they're opening the door to perhaps that the Fed could act if the economy falls back. So what are we doing trading through all this? As I say, at the moment, I think it's well overblown. These expectations are well overblown, but this is one of those times where the market tide, the strength of sentiment is too strong to go against with any real conviction. There's a saying that we have in markets that markets can stay rational longer than we can stay solvent. So I'm really itching to counter this expectation, but I know that it's very strong, and I can't really do that. Or if these moves carry on, we could see 300-400 pip drops in the dollar, and that's not something you can stand in front of. But what we can do is we can pick our moments, pick our trades, and the big key moment coming up is Friday's jobs report. This is going to be very important. These NFP reports for the last maybe year or nearly 2 years haven't been that important. Yes, we've been kept an eye on wages because they've been behind the Fed hiking, but largely the rest of the numbers have been unimportant. The market's glossed it over. Yet jobs market's doing well. It's great. It's strong. No worries there. So even when we've had these blips in the jobs reports, they've been brushed over, and pretty much after any sort of knee-jerk reaction, we've seen markets come back. But this time it's different because of these expectations. The market is going to jump on any big data points that miss expectations or look like we're going to see a reverse of the trend. So Friday's jobs report is really important. We've already had a cat put amongst the pigeons yesterday with the ADP report coming in very low. Again, there was some nuances within those numbers, but it's shaken the market up, and we're going to get the same on Friday. But as I say, we have to look at the numbers in particular. And what we're going to see is, if we get a bad headline NFP number, that's one thing. Okay, we always get a reaction on that. But it's going to be the usual wages that's going to be key, and the unemployment rate that's going to be key. Now, we've got to remember that the jobs market is super strong. So even if we do get a bad number, even if wages fall back by a couple of points, even if the unemployment rate goes up to 3.6, 3.8%, it's not going to change the trend. But in terms of market sentiment right now, that could be a big deal. So if we get a miss on any of those numbers, we're going to see the dollar suffer again. We're going to see bond yields suffer again, and the market's going to ramp up these expectations for Fed cuts. If we don't, then perhaps we've got to counter trade, and if we're getting quick enough on the numbers and they are reasonably good, then getting into any knee-jerk dips in the dollar or in bonds, in the yields, that's going to be a counter trade to go with. Jump onto that and see where you can ride it to. But remember that even if the numbers are solid, the market's not going to give up this bone too easily. So that's pretty much how we're trading the Fed at the moment and those expectations. So I wish you good luck for Friday.